Oryx's growth has really been the underpin of our strategy, our 2025 and 8 strategy. So for the last 3 years, we've been solidly building on the growth of the portfolio, and we've acquired a number of assets. In this last financial year, we acquired the Plaza asset in Swakopmund, and that was part of our strategy to diversify our asset base within Namibia. So this rental growth was not just through the acquisition, that certainly helped, but our underlying portfolio has also been doing well, and that's really due to a lot of capital projects we've embarked on, our vacancies that we've really worked very hard on, and some of these projects now coming to fruition. The fact that we are paying more tax with some of the tax changes that's come out is so much more a positive that our distribution is growing in this fashion. This is really underpinned by that growth strategy. So we've, as Oryx, have not had this growth, I think, since 2019, if I recall. So our shareholders and investors, I think, will be extremely happy. What we've, as a management team, gone to the shareholders' office to say a few years ago is to say, let us retain some of your earnings and invest that money so that we can really build on the foundation to grow the distributions organically and inorganically. And that's really now coming to fruition. So this growth is very much based on some of our acquisitions, our previous acquisitions like the Dunes Mall, now really coming into its own and contributing very well to the distribution. But also, we bought Plaza at a very good yield, and therefore that is making a great impact to the distribution. And I would say lastly, the financial environment is now in our favor in terms of interest rate cycles. So from an interest rate perspective, at least, even though our debt has increased, that margin is making a difference to our distribution. It's really strengthened our position in that we now have within Swakop and Walvis Bay a really good asset base. If you think about it, 2.5 years or 2.5 years ago, Oryx only had one industrial warehouse at the coast, and most of our assets were around the Commerce region and others. Now 25% of our portfolio is based at the coast, and that creates for a much more diversified portfolio. The great thing with the Plaza acquisition is that we bought the asset at an 11% yield, and our cost of funding, which we did out of debt, was sitting at 8.5 or between 8 and 9%. So that margin between the yield that we're getting and the cost of our funding is significant. Now, if you had to compare that normally in the property market, your margin, you'll be lucky if you get a 1% margin. So that was a really good transaction. And bear in mind that we bought that because we believe there is some risk with that asset, and we will be developing that asset over time where the yield may reduce, but at this point in time, it's really adding a lot to our distribution. And that's why we are able to give an 11.4% growth to the distribution to our shareholders. So you've asked two questions. The one is around the trends, and the other one is what we are seeing in the portfolio. I think from a trend perspective, we are definitely seeing cap rates compress. So that means the market is buoyant. There's lots of property transactions going through, and that means property prices are getting more expensive. It's also a factor of cost of funding reducing, which is also a positive. For us, in our interim financials, we did not do a revaluation on our Namibian portfolio because we normally do that at our full financials, but we did have a positive revaluation in our Croatian portfolio. So that Croatian portfolio has come into its own again and is starting to perform very, very well, and we've seen that fair value come through in our interim results. So if you asked me this question 3 years ago, with an asset like Roodepoort going vacant, and to put it into perspective, it's around about a 4,000 square asset, so it's a pretty big asset. If this happened to us as a company 3 or 4 years ago, our distribution would have taken a serious knock, and we would have probably seen a 10% decrease in distribution. With our growth strategy now fully working, and us having been through that 3-year growth strategy, we are now as a company able to absorb risks a lot better, and therefore we can still post a massive increase in our distribution even though that asset is gone. gone available or vacant. We are, though, making progress with that asset. It is currently going through a disposal process. So we are optimizing the asset base or the portfolio by selling non-core assets, for which that is one particular asset on the list. Very good question, and I think this question is particularly important for the analysts as well as the shareholders. Now, in the last couple of years, about 3 years ago, we did a capital raise to raise equity, and since then we've been doing investments through debt. And normally when you're doing your investments through debt, your coverage ratios come under pressure. I think what we've done very well is the acquisitions that we've done are all contributing very nicely to our distribution and to our income stream, and therefore we've managed to maintain that ICR cover at a 2.2 times basis, which I think also gives a lot of confidence that we are managing our balance sheet very well, and that when we are doing transactions, we're getting good enough margin to maintain our ratios as required. Our board and our shareholders are giving us two metrics that we are really measuring. The one is our distributions, but specifically distribution growth. And our new strategy is about growing our distribution year on year to shareholders. But in addition to that, we are comparing our distribution yield and total distribution rather, or total return rather, with the long-term government, the 10-year government bond yield. So that's important because asset managers and investors have an opportunity or an option to choose. Do they want to invest in Oryx, any other equity share, or in government bonds? And what we try and do is we try and outperform that government bond yield to be able to give shareholders a better return. This is something that we've been working on now for a couple of years. Oryx has won a tender to create an unlisted fund for the GIPF, where GIPF is the main investor. We are now finally starting to make traction with this particular fund. The investment principle or strategy is very simple. If you look at the current market with unlisted funds, the unlisted funds have struggled to find ways to exit those funds after the 10 years. What Oryx have said in our tender process is that we would like to build the fund, but we would like to have the opportunity to, when this fund exits, to exit into the listed fund. And ultimately, from a listed fund perspective, we are looking to grow to what we call a mid-cap sized fund. And a mid-cap sized fund, in our opinion, is between 8 and 10 billion. So these are all little blocks for how we intend to get to our objectives. I think what it also allows us to create the largest unlisted property fund in the Namibian environment. So we're very proud of being able to do this, but it will be hard work. But through this creation of this fund, we will utilize the Oryx listed company to do the property management, to do some of the developments, and through that also derive some fees. And those fees will be a benefit for the listed entity. So, and I think a lot of people are saying to me, "What, Maerua's back?" And that's certainly how we feel. I think Maerua has made a comeback. Maerua certainly on track again for where we wanted it to be. It was in quite a serious state that we had to give a lot of attention to a few years ago. So we've made a lot of investments. We've upgraded the checkers, as you know, which was a wonderful experience now. We've created the PwC wing, if you can call it, for their head office. And then on the other side, we did what we call the clip-on, which was the new outside restaurants, Bossas and Ocean Basket. And I must say, with these investments, and that in addition to a lot of the improvements we've made within the center with new shop fronts, as an example, in a lot of the tenancies, we are now certainly starting to see the results. So we're not just seeing it on an income perspective with the additional GLA that we've managed to build and let to tenants and new rental income. We're also seeing it with footfall. We've had footfall improvements over the last 18 months of between 20 and 40%, depending on which month you're looking at. So we're seeing some serious increase in footfalls within the mall, and that also means serious increases in turnovers for the tenants. And as they say, a landlord is in a much better place if their tenants always do well. So what we do with these type of shopping centers, we try and get as many feet as many people to spend their money to support our tenants. And that means that you will then have a good performing asset. So no, I think the investments have been extremely good. And a lot of people are complimenting Oryx to say, what we've done with the asset is tremendous. So we welcome the feedback. Oryx have now been in the corporate bond space since 2015. So I think we've raised and we've got a lot of experience in the corporate bond space. The last time that we issued a bond, it was for a 3-year period, and that bond came up for renewal. And what we saw an opportunity within the market, that there was a lot of capital available. We've seen that the margins for funding has improved during that time. And we also saw a further opportunity to increase that size of the bond program. So initially our board allowed us to increase the bond program size from 500 million to 1 billion. And that gives us a lot of flexibility for capital projects in the future, given that this is unsecured funding. So we were very lucky. We did a bond issuance. It was oversubscribed by a long way. We managed to increase the bond issuance to 359 million from the previous bond issuance. And that was also at improved margins. And then we further allowed us to split it in two, where most of it was on a 3-year tenure and some on a 5-year tenure. So that gives us also quite a bit more flexibility. Now this, as I said, this is unsecured funding, and it allows us to really be flexible, be able to buy a shopping center and have that capacity to make such an investment without raising equity on the back end. So that flexibility gives us really a strong balance sheet position that we can unlock for shareholders. Oryx have delivered exceptional results in our first 6 months of the year, where our distribution has increased by 11.4% to 58.5 cents per unit, which I think shareholders will be extremely encouraged about, and where shareholders can now see that the growth strategy that we've been following is really starting to make an impact. We've grown our rental income, or operating rental income, by 20.4%. A lot of that is organic, but there was also some inorganic growth through the Platzamir acquisition that we did at the coast, and where we now have 25% of our asset base diversified at the coast. Those investments between Platzamir and Dunes Mall is really starting to make a difference, and you can see this in our results. We are also busy with our latest but most important investment in our history, which is the Maerua Mall. This is probably the largest social initiative and real estate project, we believe, in Namibia at this point, and that asset will start trading at the end of May. So there's a wonderful project that we are looking to conclude, and that income, or the income from that asset, will also supplement and improve our results and our financial resilience in the next 12 months.